Good morning and welcome to our deep dive into Tesla today. And now, in case you've not had your head in the markets for the last couple of weeks, it's worth just recapping the share price rally that we've seen in Tesla. It's been quite spectacular. Really since the last year, we've seen it really start to pump higher. But in the last few days, it's been on a almighty roller coaster. The shares rallying up 20% in a day, topping $900, and then yesterday suffering a major setback and now trading down to around $730. So $200 off its highs in a week. It's been a massive turnaround. Been up, still up, very, very large amount versus where it was trading last year, of course. But the big question now that we're seeing is to what extent any gains that we've seen can be maintained. Will we see $900 again, or is this blow off top the sign that it's a bubble that's popped and we might have to retrace back to this sort of region here, or even all the way back down? Well, there's a lot of this needs to be based on fundamentals. There's obviously been a lot of buying, momentum buying, and herd following going on. So we're trying to strip out some of the noise that you hear. It's very difficult, I think, to gauge whether or not the stock that's rallied 100% in a week is worth $950 or $930 or $900 or $700. It's very difficult to really price that in, because what that is pricing in is a phenomenal amount of growth. It's worth remembering that Tesla's always been a Marmite stock. It has had just as many detractors as supporters. There's been an awful lot of short interest, and we have seen that through this rally, a lot of that is a short squeeze, and one of the worst short squeezes we've probably ever seen. Shorts are this year alone down about $8 billion. Although that after yesterday's fall, they may have clawed some of that back. What we have seen though is a sharp turnaround in the fortunes of the underlying business since Q3. If we look to back in July, as recently as July, we were casting doubt on the viability of the business itself. Credit default swaps were trading at well at 30% or something like that, now trading at 2%. So there's been a massive shift in the CDS positions, which is a reflection of the market's belief in the viability of the company. Remember that even if we're seeing Tesla trading at $400, that's still a company making money, that's still expecting growth. $900 is something else entirely. But not that long ago, we were thinking potentially it could be back to $50 or zero even. The first quarter of last year was bad, very bad. But since Q3 things have picked up. In fact, I think the second half of 2019 has been a turning point. If we go to Q3 last year, Tesla it surprised the market and made $143 million against a loss of $1.1 billion in the first half. Revenues were at $6.3 billion, but it seemed to have turned a corner, cut costs by 16%. This has followed through into Q4. Now, after those Q3 numbers, in my morning commentary, I suggested that was the turning point, and I think analysts and the market has agreed, and I think the Q4 numbers have confirmed this very much. Also, there's a lot of excitement about the Model Y. That sales of that car are going to exceed everything else that's gone before combined. We've got production happening sooner than expected, and we've got deliveries happening sooner than expected, and we have Elon Musk confident of hitting 500,000 vehicles this year. What the analysts say, well, they're saying that there's been a significant reduction in the risk premium attached to the asset. We know that. We could see that with the share price. But if we look at China, for example, Morgan Stanley saying we're giving Tesla credit for a faster ramp in production, which has exceeded initial expectations by 6 months. Signs of increased government support for Tesla in China, more supportive electric vehicle macro environment in China for the coming year. This is the world's largest electric vehicle market, and it's yet relatively untapped. I think there's a sense that with the new gigafactory in Shanghai, Tesla's very well placed to take advantage of that. And as we look structurally, the shift towards electric vehicles is going to be rapid over the next decade. The UK this week has said that it will ban all petrol and diesel vehicle sales, including hybrids, by 2035. So who's best placed to take advantage of that? Well, it's Tesla. Wedbush, in our opinion, the company has the most impressive product roadmap out of any technology or auto vendor around, which is the market cap reflects versus its traditional auto competitors. It will be a game-changing driving force for the electric vehicle transformation over the next decade, with Model 3 front and centre. So the belief very much is that Tesla has hit an inflection point over the last 6 months and is now able to keep rolling. Question marks, downside? Well, I think there's obviously when the shares were trading at around $600, UBS put out a note that upgraded their price target towards that $600 level, but they still reiterated a sell rating because they said that all the likely growth was fully priced. They pointed out that at $600 there or thereabouts, the stock reflected sales of 1.6 million vehicles by 2024 on an operating margin around 10%. So when we get to 900, that's suggesting sales of well in excess of 2 million. Now there's 500,000 expected this year. They need to ramp production again and again and again from these new factories in order to hit 1.6 million. To hit 2 million and beyond looks a massive stretch. So even at 1.6 million by 2024, that's really around there, we think, at least according to the UBS analysis. There's also question marks over the debt and the fact that given the share price has rallied through here and Tesla was prepared to tap investors when it was trading at $300, $350, $400, they should be looking to tap investors again now and take advantage of this. Therefore, we might expect some share dilution. So, in short, lots to say that Tesla has hit an inflection point, it has hit a turning point in terms of its fortunes, but there's a lot of execution risks lying ahead. We also know that, for example, already deliveries from Shanghai are going to be hit by the coronavirus, so there's near-term risks. But in terms of the share price movement, beware, because these are big moves and it could come crashing down further, but equally we could equally be heading towards $1,000. The range of the analyst notes is interesting because most of them have a bull case as well as their base case, and the bull case is very, very powerful. The stock trading well up here, but their normal base case is still for it to continue around this sort of 600, between sort of $450 to $600 at the moment. But we'll try and keep you up to date with any changes in these analyst expectations and what they're saying about the stock. At present, consensus is sell with an average price target of just under $500. A lot of the analysts have recently upgraded their price targets to reflect the rally. I'd be doubtful whether they're going to do that again, having seen it hit $700, but we'll wait and see. And like I say, we'll keep you updated with any changes. Thanks for watching. That's it for now, and we'll be back later.